Morningstar just threw a curveball at the FIRE community. For years, the gold standard for early retirement has been the total return approach, ignoring dividends and just selling shares as needed. It's mathematically clean, but is it realistic when the markets tank? Christine Benz, one of the most respected voices in financial planning, just admitted she's changed her mind about dividend stocks. And today we're walking through her shift in logic and seeing if the math of experts like Karsten Jeske still holds up against the psychology of a bear market. Welcome to Real Fi Talk. I'm Aaron. On this channel, we look at the ups and downs of financial independence, how to achieve it, and how to sustain it. If you like this type of content, please like, subscribe, and hit the bell below. Also, please share it and leave a comment. I'll respond to all of them. All right, let's get started. So before we get into this article, I thought it might be helpful to just define a couple terms. So let's define total return. This is the combination of an investment's capital appreciation, so the price goes up, plus any yield, dividend or interest. And in the FIRE world, we usually care more about the total pot growing than how it grows. So what is a dividend? A dividend is a portion of a company's profit paid out to its shareholders. Think of it as a thank you check for owning the stock. Importantly, when a company pays a dividend, its share price typically drops by that exact amount. Safe withdrawal rate, or SWR, this is the percentage of your portfolio you can take out each year without running out of money. Karsten Jeske, who's one of the kings of researching this, he's really become an expert at explaining what rate you can hold that will last over a 30 to 60 year early retirement period. So let's get into this article. And Christine starts by acknowledging her original bias, that dividends are irrelevant because you can just create your own synthetic dividend by selling shares. And her quote here is, "I've long been a skeptic of dividend-focused investing, but I've softened my stance." And she admits that while dividend irrelevance works in textbook, it often fails the sleep at night test for actual human beings in retirement. And she also talks about in this article that dividend income has shrunk as a percentage of market's total return over the past several decades. Dividends contributed 73% of the market's total return in the 1970s, but has ranged between 12 and 16% over the past 4 decades. So appreciation is making up more and more of that total return. She also mentions that dividend payers also have more tax disadvantages relative to non-dividend payers. And even though the tax rate on qualified dividends is on equal footing with the long-term capital gains rate, 15% for most investors, dividend investors are ceding a level of control. But even said that, she's learned to stop worrying about dividend stocks. And there's a lot of arguments against them, but there's some arguments for them. And it's the role of dividend payers in retirement. And she talks about this Vanguard High Dividend Yield Index ETF, for example, that has a standard deviation of 13 over the past 15 years, where the total market's index standard deviation has been 14.6. And in 2022, which was her kind of stress test example, the total stock market lost 19% that year, and dividend-focused ETFs lost less than 1%. This is really about behavior, though, and Christine Benz gets into this more into the article, where she talks about there's a powerful psychological benefit to receiving a paycheck from your portfolio, and it helps investors stay the course. And she quotes David Blanchett and Michael Fink in their study, where retirees were found to be more comfortable spending their non-portfolio income than they are cracking into their savings. And dividends occupy a comfortable middle ground. So cashing a dividend check or having dividends sent to your cash account is simply easier than venturing in your portfolio and figuring out what to sell. Of course, Karsten Jeske, Big Earn, would push back, and he argues that this paycheck is really a forced sale. And if you're in a high tax year trying to stay under income limits for healthcare credits such as ACA, those dividends really are involuntary income that you can't turn off. So she does wrap up here, though, talking about that it's not worth chasing yield. The highest yielding stocks can be value traps. Companies with deteriorating fundamentals exist. And what is this yield trap that's being referenced? It's a company looks attractive because it's historically paid a 10% dividend, but the only reason the percentage is so high is because the stock price is collapsing. And usually companies that are paying out those higher dividends may be on the downward curve for innovation, and that's why they're no longer investing back in their own company. So what's the answer here, and what are some of the suggestions? I'm not a financial planner, but I think the answer here is something of a hybrid strategy. Don't go 100% dividend stocks. Use probably a total market fund like VTI for growth, and then complement it with something like VIG, which is a dividend appreciation fund for stability. And you've got to be aware of sequence of returns risk, and the risk of a market crashing right after you retire does exist. And Christine Benz argues that dividend stocks can mitigate this because you don't have to sell some of those shares at the bottom to pay your bills. The other thing is sequence of returns risk. This is the risk of the market crashing right after you retire. Benz argues dividends mitigate this because you don't have to sell shares at the bottom to pay your bills, just like in 2022. So what's the final verdict? Well, I think overall, over decades and decades, the math favors a total return approach, but the human heart probably favors dividends. And for a 30-plus year retirement, you probably need a little bit of both. So like I mentioned, I'm not a financial planner. I'm a DIYer when it comes to investing, but I thought this article was pretty interesting. What do you think? Do you have dividends in your portfolio? Are you living off dividends in early retirement? Or are you going with the total return approach and just selling shares when you need money? Let me know. All right, have a good week.